All right, traders, welcome to today's recap. This is Christian from Tribeca Trade Group, and it is Monday, March 8th. So, a whole bunch of mess up here. All kinds of rotations going on under the hood again. We're going to talk about that. Theme of the day: the Dow versus the Qs. Are we there yet? I'm going to show you some charts. You could formulate your own opinion for these types of things. IWD, large cap value versus large cap growth. We can look at small cap too, but the question is, are we there yet? Right. So I know that I've been getting a lot of questions. I think a lot of people on Twitter too are kind of wondering, who have been just over positioned in growth, that are taking shots at growth here and thinking, well, this is going to straighten itself out sooner or later. So I think that that's the number one question, right? Is how much further can these things go down? And it's really difficult. I mean, it's kind of, first of all, nobody has a crystal ball. I don't have a crystal ball. So what I try to do is really kind of go over some relationships and where sentiment is, if we're washed out in sentiment or if we're just not there. And so let's go through a couple things here. So we'll start with, and by the way, if you can't read this because it's blurry, because it's not in high def, YouTube takes an awful long time these days to render these videos. You could I always put the screen print on Twitter. So you'll have this on Twitter. You could follow along that way, because I know what a pain in the neck this YouTube is. Risk disclaimer in front of you: everything that we're going through is for information purposes only, not giving out any advice or recommendations. We'll go over sectors here in just a minute. Let me just clear that out. We'll talk about the ARK funds and what they're going through too. But let's start with the S&P technicals. So one of the things that I keep referring to with the S&P is that, and S&P is important, right? It's the 500 largest companies. Now, it is a market cap weighted index, but we have not been able to. So just analyzing the technicals is pretty easy here. We're still at the 50-day moving average. We're right around that. We're at the bottom of value, but we just cannot seem to turn the corner, right? It reminds me a little bit of Chevy Chase National Lampoons. He's going around. He's going around the circle. Kids, Parliament, Big Ben. This just can't get right. We keep stalling basically at the downward trend line, right? So this relationship, right? And you can't really put a finger on this when this is going to change, but we continue to make lower highs, right? It's something that I've been talking about for the last few weeks now, and as long as that pattern is intact, you want to be selling. You want to be selling the rips, not buying the dip right now. Selling the rips, right, and especially into that downtrend line. So I drew this, back in here, and I extended the line, and you could see it's really valid. So, I've got the value areas too. This will be nice for confirmation, 3904. But you could see we cannot get over. We cannot. The indices right now, or the S&P, I should say, cannot turn the corner and get back into short-term uptrend, right? And again, it looks a little bit more pronounced when you look at this on the daily chart, right? So this just is what it is, guys. It's a technical pattern right now, and the hardest thing I think for most traders, myself included, is just to sit on your hands and wait for this to show. The issue is a lot of traders, they always want to try to catch the absolute bottom. You're not going to catch the absolute bottom, right? It's going to be, unless you really get lucky one particular day, right? You're not going to catch that day. What we try to do here is, watch when the trend changes, not catching the absolute bottom. I see just too many people trying to do that on Twitter too, right? Oh, it's a buying opportunity. It's a buying opportunity. Really? Because you don't really know. You don't. So if we turn over, so I guess, the next thing to go through is just to look at the Qs and what's going on here in the Qs. So we talked about on Fridays, my public video, and I said this as well in the member videos this weekend, but one day doesn't make a trend. And we had a really nice, hammer bar that came in on Friday, and it looked like it was a great kind of opportunity to say, to kind of stamp that low out for the maybe turn on it. But you could see here, and it's one of the reasons I know some people don't like to put moving averages on charts and so forth. But one of the things that helps me is to put the 5 day exponential moving average on my charts. And I'll tell you why. It really helps me see the trend. And you'll see when price will really behave, very well on that, right? And you could see, the particular situations in the past where, this is what we saw back in October, right? Until price got above this, you couldn't really time. You had to wait for a little bit of confirmation, right? And there's a little bit of a retest back in there, but it's the same thing right now. So as great as Friday's candle looked, it did not get over the 5-period moving average. Again, that tells me what the short-term trend is doing. If we get back above that, then we have a chance to reverse the trend, but we're not there yet. And again, what I see looming is, which I've gone over in a couple of these videos, but I mean, I think this 289 to 291 would be a better place to buy the dip if one were to do so. And we'll see when I think, that's where we're headed, to be honest. And right now we're in no man's land, right? And if you look at this on the weekly chart, there's where 289 lines up, right? That's the top of value. So will we be oversold at that point? It could be. Will we have washed more of this sediment that keeps buying the dip every day out? Sure, I think so. I think it's a little bit more constructive. We'll have to see where the put-call ratio was, but I think the put-call ratio today was a little bit higher than what we saw. So, and I just started to see that too in a lot of international names. We're started to see put buying. I think people are starting to get worried about the dollar, something that we've talked about last week too, that it's going to get troublesome too. I know that everybody's looking at interest rates every day, and bonds were down again today. That would be a nice relief bounce. If the bonds happen to bounce one day, you may be able to get out of some of your longs if you've gotten trapped in them, right? So we'll see if that if we get to that situation. But there's another virgin point of control down here, so I'm wondering if this is going to get taken out first. And then we bounce, or if we bounce and then come back and go get this thing down here at 155. And again, TLT is different, a little bit different maturity, but again, showing downtrend, right? We're back to where we were at the lows for this. And then UUP, which is the dollar, an easy way to track. There's a VPOC up here. Again, another big day for the dollar. I mean, look at the moves that this thing has been making, right? You just don't see this moving that much. But now so far, we're starting the week with a stronger dollar again. So, we've got some complicated stuff going on, and that's kind of. If you want to put a story around what's going on with all the growth names, you got multiple things going on, right? You've got now a stronger dollar, you've got higher interest rates, and you've got the company, excuse me, I always say that. You have the country reopening too. So all of those things that were, heavily needed last year, Zoom video, Peloton, right? There's less of a demand for those things, right? It's so funny. Like I see a lot of traders, and again, I think these things will eventually bottom, but you just have to realize that with the country going to be reopening, right? We're hearing about it state by state. There's just going to be less people ordering Pelotons. It's not to say that Peloton or Zoom is a bad companies. They're not. They're good companies. They're just not in as high demand as they were a few months ago, right? So you have those combination of things going on. And I know I've been talking about this now for 2 weeks, but I still think people are trying to buy the dip in some of this stuff. And I understand, but you just don't know how much lower these things are going to go, where they're going to be a little bit more attractive, right? Does that I don't know. It seems like when I say this to some traders, it doesn't make sense to them that the country is reopening and that people are not going to be buying as many Pelotons, right? People are not going to throw their Pelotons out, right? But they're not going to if your company is based on growth and high growth, right, you're going to need to continue to have that type of orders that you had last quarter. Because what I continue to hear from some traders is, well, they had great earnings last quarter. That's in the past. And if you have a high multiple, you're going to have higher growth next quarter. And if the country's reopening, if people are going outside a little bit more, odds are you're just not going to get as many orders as you did when the country was shut down. Now, again, I am drawing a conclusion there, but doesn't that kind of make sense? So I think that's in addition to the interest rates and the stronger U.S. dollar, you've got that going on. So that's why some of the money is coming out of these things very quickly, right? So that's my little story. I think the dollar is important to watch. I think bonds are important to watch. And I do think, those short-term moving averages. Again, if I had to guess, I think we're going down to 289. So, or 289 to 290, and hopefully that's as far as it goes. But we'll have to see when we get there. There's just too many things that look very, very weak to me. Now it could, and of course, it doesn't mean that we go straight down there. We could get a relief bounce, right? If bonds rally tomorrow for some reason, that's the case. But Powell won't speak again till next week, right? That's the Fed meeting. So, he had a chance, and I didn't think that there was anything that Powell was going to say different, and he did not say anything different. But if they're really going to get worried about what's happening, you won't hear from him for another week, right? So that's St. Patty's Day when the Fed meeting is, right? That was just a speech that he was doing, for the Wall Street Journal last week. All right, so now what else is going on, right? Now the diamonds made a new high today, right? So I find this particularly interesting. Now they did not close on their highs. There was just too much market pressure, right? There are things in there's 30 stocks in the diamonds, but you do have some tech in this. So it's going to be very hard for that index to just continue to break higher when there are tech and growth names in the Dow. It's not all value. But you look at what's happening here. So going back to my question, my theme of the day, one thing that can kind of help a little bit is to realize while the country was in COVID lockdown, is look at a 5-year chart of the diamonds versus the Qs, right? Look at the performance of how bad the diamonds underperformed to the Qs over the last year and a half. Basically starting all the way back at the end of 2019. So do you think if this is now doing something different, right? It's now above the 50-day moving average when you look at this ratio. Where do you think it could get to? 1.1, 1.2? So I looking at something like this tells me that if there could be a longer runway for where something like the diamonds outperforms the Qs. Now, again, it could check back. We've seen these things. It doesn't have to go up there in a straight line, and it's going there in fast and furious. So I would think that there should be some digestion, but I don't think even if like you have 1 or 2 days of the Qs rallying, that might be like something that you want to sell into, because I think that these relationships have changed, right? And if you look at the other one that I keep bringing up and keep posting on Twitter to try to help, like I'm not doing this to say, I'm just trying to make sure that people are their minds are thinking properly about what's transpiring here. So this is all the way, wow, this is all the way closed at close to 0.65. So we're almost there to 0.7, which is a ratio that I've mentioned a couple times. So yeah, we're getting to the point where this is really reverting fast. So this is again is large cap value over large cap growth. So, it's pretty amazing how quickly that this is happening. And if you look at some of these stocks, and again, you have to ask yourself too, we were talking about this in the trading room earlier. Joe Fahmy did a great job at this too. Joe Fahmy is one of my favorite follows on Twitter. And in his weekend video, I had a chance to listen to some of it. And he's more of a growth guy. And I'm putting words in his mouth a little bit. But he was saying that, if you don't want to buy some of these value areas, then you just kind of sit on your hands, right? And like, I'm not going to buy AT&T. I just don't believe in the company. I don't, some value I am definitely buying, but I'm not going to buy AT&T. I'm not going to buy Philip Morris either, right? Which was up 4% today. Interesting that took out a Virgin point of control up there. But these are the things that you have to ask yourself, right? There's money obviously that's rotating big time into some of these areas, and you just have to ask yourself, do you want to participate in it, or do you not? If you want to participate in it, then there's certainly things to kind of participate in. I've been posting a lot of these charts. I know they don't get much recognition. There's a service out there that actually puts out popular tweets of people on Twitter, about stock tickers. I'll tell you, this is a great contrarian thing to use right now. Being popular, right? It's being popular doesn't mean you're going to be right, right? So I'm not mentioning this service's Twitter handle because I don't want to badmouth anybody, but tweeting out the most popular things is actually a detriment right now to people, because you want to be like, if I was in their shoes, I would be tweeting out who's correct, not who's most popular, right? Because in Twitter there's a bunch of salesmanship, right? People buy followers, they buy bots that tell them how great they are. This is not people that you want to be following just because they're popular. You want to be going after what are the best setups, right? And I think the rail names are interesting, even though they didn't close on their highs today. The industrials, right? I mean, they did break out, although that's an ugly looking candle. But, it's better to be in something that's up 1% for the day than something that's down 7%, in my opinion. So those are a couple choices that you have to think about, is whether you want to get involved in some of these things. Like I'm long I've been long RTX for a while. Didn't have a great day, but still up 60 basis points. But these are the things where the charts are just looking better. So, I don't mind going on. Like, I think Raytheon is a good company. It's a little bit different for me than an AT&T or a Philip Morris. Right, so those are the things that I can try to do. One name I got stopped out in today was ICE. I actually could have kept this on, but I just don't like how this market is looking. So I can get back into this tomorrow. It's not a big deal. But MasterCard and Visa, again, they didn't close on their highs, but they're just showing the strength right now. And if you look at this chart and cover up the symbol, now again, you're not going, nobody likes this, but these things have been basing for a long time. Who's to say that MasterCard and Visa can't break out? So I continue to kind of put my points out there and put charts, and I put these charts out over the weekend. I look, and it's funny because of the charts that I tweeted out this weekend, right? And I put a bunch of them out there. I put the rails. I put some of the names that we're talking about. The one that got the biggest like was the growth name, and I said, hey, I want to be super selective with growth right now, and I think I tweeted this name out, C Limited, which was down 10% today. 10%. This one got the most likes, so it's odd to me. I get it. It's a cool company and so forth, but if it's breaking down, it's breaking down. Now, the other thing too to realize with this stuff is, and people get excited about this. They're like, "Oh, why is it down 10%? It's such a good company, yada yada yada." Yeah, it is a good company, but it's still up from, if you look at where this company was trading a year ago, right? A year ago, it was trading at $40. Is that right? Or am I not going back far enough? Here's January. Yeah, so it's still up. It's still at $200. So I think the reason why I'm doing this is to help you put things in perspective. It is still up a monster amount, right? So these things can fall a lot further because of how much they've gone up over the last year. And you have to think it's kind of fair. What's fair is fair, right? A MasterCard hasn't done anything because they do a lot of travel booking and so forth. So you look back and where this company was trading a year ago, and it's right around what? It was at 341 and it's at 371 versus SE was trading at $50-$60 and it's still at 200. So that I hope this kind of helps a little bit and says, there could be a lot further where some of these things fall because of the growth that they've had over the last year. Okay, and realize where your stop prices are and realize what's happening here. So you just have to be open to all outcomes, is the point that I'm trying to make. Now, let's talk a little bit about sentiment. What's particularly troubling to me, I'm not trying to be bad news, but just kind of like, there's so much condition out there that people just say that they want to buy the dip. And I don't think a lot of traders are putting things in perspective like that. Here's one thing that's particularly troubling. Right? So I tweeted this out earlier too. The leveraged funds, people who are putting inflows into leveraged ETFs. These are not usually this is not smart money. I would actually refer to this as a little bit of dumb money, right? If you look at what happened in September, they were the first ones in to be buying the dip. Now, I think they got away okay, but you could see the timing that they had. It was not good, right? So right now you don't see any fear. You don't see inflows going into short ETFs. You see them going into long ETFs. To me, it doesn't fit right, right? And if you look at the semiconductor one, which the semiconductors, that was one of the things that didn't sit right with me earlier today, was that the semis are continuing to fall, and I view them as a leading indicator. They look at all the fund inflows going on into the long, triple levered long semiconductors. Wrong time to be doing this type of thing. If you look at the SOX S, right, which is short semiconductors. Now maybe this will change. I don't know why this isn't coming up for me, and I don't want to mess this up. SOX. Right? So there's big volume, but there's not big inflows. So nobody's wagering on this right now to be going short the semiconductors. Notice what happened back in, as an example, last year, right? When we had the big dip in the market, people were actually thinking that the market was going to go down a lot further, right? And these fund flows were wrong, right? That's what I want to be seeing over here. I'll give you another example. This is SPXU, 3 times short the S&P. SPXU. Let's look at what happened last year. Everybody was thinking that the market was going to go lower in terms of this party who was doing this back in April. And this was a great contrarian indicator. What's going on here? Nothing so far. Nobody's thinking that we're going to go lower. So that's kind of where sentiment is right now. I do think it's encouraging that put-call ratio is starting to move up, but I don't think there's enough fear out there when everybody's still like, it has not gotten washed out where people are throwing in the towel. I still see too many people wanting to buy the dip in these things. So nothing is 100%. We don't have to get to that point, but I think when we get more of a washed out type feel where everybody's throwing in the towel and doesn't even want to look at a software company, that's usually when we start to go up. So I don't think that we're at that point yet, unfortunately. Let's go over the next. So that's why if you were to make me make a prediction, I think that we go down here and then maybe people get a little bit more. Things get more washed out, but we'll see. I don't want them to go down there. I'm not rooting for that outcome. Just saying, these are things that you kind of have to think about. All right, and it's pretty remarkable too. Metals and mining up 2.7%. Home builders, which I talked about on Friday too, they did quite fine today. And what's really odd with this, right? There's 60% home builders in this ETF. It's called home construction, but it's actually home builders. With rising rates, the builders are doing quite fine. So odd, isn't it? And of course, the banks did fine today too. So they were up another 2.6% for the day. So it just shows again where I believe that we got to a point where it was extreme positioning, in terms of tech and growth. And, for a while, just people just did not want to put any money in value, which I understand. It just didn't work, for a while. But now it's working. So take a look at some of these ratios. I hope that I'll show you. I will show you my trades for the day. All right, but I even sold this crowd a little bit too early. Like I think it went up to 190. But David Tepper spoke today and gave a little bit of a relief bounce in the Qs, and that was my chance to kind of like, I realized that over the weekend, I was like, you know what, putting on this crowd strike may have not been the best idea. I was just looking for a bounce, but there's too many things going on here, so I got my bounce and I got out. All right, that was my entry price on Friday, and I took advantage with that rip. So again, selling the rip right now in technology. I tried a couple other trades. This is a little bit too much growth. I had to get out of it. I also got out of Taiwan Semiconductor. I did not like the way that semis looked. Where did this Taiwan Semi get down to today? So it got down to 113. I sold this at 117. So again, 117 getting in at 118 is not a big deal to me, right? Taking a dollar loss and after taking one target at one small target at 120, that's fine to me. I'll take a shot at it, got out, lost a little bit of money, dollar, so be it. Thing went all the way down to 114. GM played a little bit of GM calls today for a day trade, got out of them. Here is my ICE trade. I took it off at the end of the day. I just don't like how the market looks for now. Took a small winner in WGO, and you can see I hate to short in the hole, but I'm feeling that we go lower, so I put on just a little bit of a hedge, and I don't want to make money on that. Because if I make money on that, then some of the other things I'm holding aren't doing well. So that's a lot of money for a weekly put, but I don't think it'll go down to zero if I'm wrong, right? Or if I don't need it, maybe I get out of this at 280 or something like that, which is fine to me. Deer is another. I talked about Deer and Caterpillar. I got out of my last Deer today. All right, so this was nice. So again, some nice trades, but some other things. I'm holding besides the Taiwan Semiconductor. I'm holding Applied Materials, which I've gotten beat up in this trade. This is now breaking. I thought we had a chance to turn the corner here. I'm in calls. The premium's down a lot, so I just holding on to them. I added a little bit of Microsoft. I started position on Friday on Microsoft. Microsoft was holding up for the majority of the day. Now finished down 1.8%. So lost some money on that. So it's tough to get out of these days unscathed. And I will say again, the less positions that you have on, the better. All right, guys, have a great night. Again, we'll just kind of take this bottom line one day at a time and try not to stick your neck out in any particular areas thinking that this is the bottom. The other thing that I know this video is long, but take a look at how the Q started for the day. Every time they try to rally, they could not get over making a lower high even for the day, right? We talked about that in the S&P in the beginning of the video. But look at this, right? Bounce, but not recouping any of this. Next bounce, lower. Next bounce, lower. Next bounce, lower. That's the pattern that we're in right now. All right, guys, have a great night. See you tomorrow.